Vicky Zhou is an economist with ANZ's team, normally based in Hong Kong, but today in Sydney. Now, Vicky, many thanks for your time. I just wanted to get your sense as to the permanence of what's taken place between China and the United States overnight.
Thank you, Rose, for having me in the show. So yesterday, we've seen China and the US had a joint announcement on its trade deal. It's definitely above market expectation. What we need to watch is the permanent working mechanism for future trade talk is going to be established. So we are looking forward a second phase of the trade deal to be announced in the next few months.
OK, so then take me to something else, because it would seem to me that the speed with which these negotiations came to an agreement, and that wasn't expected. It was really a situation where economically both countries, the United States and China, were hurting significantly as a result of the tariff war.
Definitely. So I believe both sides realized that more than 100% tariff rate is not going to be sustainable. So from China's side, we've already seen early signs of economic shock. So in April, the PMI number was below 50%, and also the export to the US reduced by 20%. Of course, on the US side, the inflation pressure is mounting. So I believe both sides has the interest to dial back the tariff rate on each other.
OK, so tonight we see inflation numbers come out of the United States. That also is going to show the impact of these tariffs on United States inflation. And if prices have risen significantly, that might be another reason to be stepping back from the brink of these excessive tariffs, especially on China, where so many imported goods come from.
Definitely. And what we need to watch on is yesterday's trade deal did not include low-value good under US dollar 800. And the US so far hasn't announced any tariff reduction on those products. And then if this high level 120% on low-value goods continue, it will definitely hurt general household in the US and then keep pressure on the US price.
Right, so that's the case, because you've got now tariffs of 30% on goods coming from China to the United States, 10% going from the United States to China. It still means that a 30% tax on goods coming in from China is excessive on where they were, let's say, going back 6 weeks ago or so. And this also is going to continue to keep at least some pressure on prices in America.
Yes, and then we do believe that the 30% tariff US imposed on China can be further negotiated down. And yesterday's announcement did not include the 20% tariff on fentanyl issue. So we expect further engagement between two countries on fentanyl issues that will bring the 30% US tariff on China to 10%.
OK, so then, there are going to be some beneficiaries. One thing that I understand is already in America, manufacturers and others are ordering significant amounts of Chinese goods because they've got 90 days, they know, where the tariffs are coming down. And so it's likely to stimulate an enormous amount of demand coming out of America from retailers, manufacturers and others trying to get Chinese goods into the country as quickly as they can before that 90 days is up.
Exactly. On China export front, we are expecting the export to continue performing very strongly in the second quarter before the next wave of uncertainty. And then we also see an upside risk to our China GDP 4.2% this year if the China and the US trade deal can be significantly reduced.
It's going to be fascinating to watch it. I'll tell you what, Vicky Zhou from the ANZ team in Hong Kong, thank you so much for your time on the program today.
Thank you.